Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about SoFi Technologies, Palantir Technologies, and Tesla stock. The first article we will be analyzing today compares SoFi Technologies to Upstart. Both of these companies are fintech companies, and many newer investors seem to be gravitating toward these types of stocks. So we will compare SoFi Technologies to Upstart, and even though they do some different things, we want to compare where they overlap, such as their personal loans. So I'll tell you which company and which stock I like better at the end of this article once we analyze it. And of course, up next we have Palantir Technologies, where this author believes that Palantir stock deserves a rating change because right now the majority of experts, professionals, and analysts believe just to hold this company right now. And then lastly, we're going to talk about Tesla's TSLA stock price and how it could surge over the next few days once their delivery numbers officially trickle in. So we'll be discussing just how high their stock price can actually go regarding Tesla stock and their TSLA share price. So for more SoFi stock videos, Palantir stock videos, and Tesla stock videos, remember to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. Like I said, we're going to be comparing SoFi Technologies to Upstart, and both of these companies are online lenders. They provide various applications which streamline the process for consumers to obtain funding, and each company has their own advantages and disadvantages, so we'll be analyzing their pros and cons. Upstart is a good choice for borrowers with a fair credit score, while SoFi, on the other hand, are for customers who have a higher credit score. There's also differentiating factors between these two companies, such as their limits, interest rates, and how this impacts their overall stock price. And I'll tell you where I think these stocks are headed in the future. But let's start by analyzing Upstart. So essentially, Upstart is an artificial intelligence-based lending company that offers personal loans that range between $1,000 and $50,000. Essentially, Upstart's AI platform allows them to take on more customers because they don't normally judge people by their overall FICO score, and instead they let their AI determine how risky borrowers are and whether or not this institution should lend money out to those specific people. For instance, Upstart specializes in less qualified borrowers who find a harder time gaining money or getting a line of credit or taking out a personal loan from other institutions. But in this video, we will be honing in on their personal loan segment. And what makes this company very innovative is that they consider non-traditional variables that are not incorporated in your FICO score or your overall credit score, like education, employment, location, and many other factors. So what are the pros and cons for this particular company? Well, first, I would say the payback period has to be between 3 to 5 years. Their overall rates are somewhat high, ranging from 6.7% on the low end, which is phenomenal, all the way up to 36%, which is absolutely terrible. Borrowers are also charged an origination fee, which range anywhere between 0 to 10% of the loan amount. So if I wanted to take out $50,000, I would end up paying, just in a fee, I could end up paying around $5,000. On top of that, any late payment fees which occur are going to be equal to 5% or $15 of the total amount, and the institution will pick whichever one is greater. So although there is accessible application requirements because you only need a minimum credit score of 600%, then their artificial intelligence platform will determine your overall credit worthiness by analyzing your debt to income ratio and multiple other facets. The company also qualifies you with soft credit checks, and loans start as low as just $1,000. They also have something that's pretty cool, which is called a hardship program, where they offer eligible borrowers a relief program in case they enter into financial hardship, such as a job loss. And those are actually the pros, and here are the cons. They have limited repayment terms, normally ranging just between 3 to 5 years. They have very high interest rates, going as high as 36%, which is crazy. There's no auto pay discount, and they have high origination fees, which brings us to SoFi Technologies. SoFi Technologies is essentially an online digital bank, but they also give out personal loans. So let's see how SoFi stacks up against their competition. They can provide personal loans from anywhere between $5,000 to $100,000 with repayment terms that range anywhere between 2 to 7 years. Their overall interest, which they charge, start at 9% for their personal loans, and they go all the way up to 24%. You can get pre-qualified with a soft credit check, so there's no hard credit checks, which is very good. There's fast funding speeds, meaning that essentially as soon as your application is approved, the money can be transferred to your account in that same day. They also have a very high maximum, more than twice that of Upstart, going all the way up to $100,000, and they have much lower origination fees. However, what are the cons? It may be difficult to qualify because SoFi is more stingy on the types of people they actually loan to. Your minimum credit score is probably going to have to be somewhere around 650, and another problem is that they have a high minimum loan amount, which starts at $5,000, because what if you just wanted to take out $1,000 or $2,000? You can't do that with SoFi Technologies. They do have somewhat high interest rates, and co-signers are not permitted. So between the battle of the personal loans, who is going to win? Here's a quick summary of what we just went over, and honestly, I would have to say SoFi Technologies, and here's why. SoFi Technologies is not only greater in the fact that they offer the ability to give their consumers a lot of other financial products and services, because after all, they are a digital bank. Upstart just doesn't really take the cake here, because what a lot of people don't know about SoFi is SoFi also has artificial intelligence involved in their underwriting policies. So essentially, SoFi is just a better version of Upstart in my personal opinion, on top of them having lower overall interest rates, lower origination fees, and as an institution, SoFi can just do more for you than Upstart can. I would say the only good thing about Upstart is if you only wanted anywhere between $1,000 to $4,000, Upstart can give you that, while SoFi you have to start at around $5,000. So in the end, I would pick SoFi Technologies as the winner when comparing SoFi and Upstart. This is actually why I don't own Upstart in my portfolio. I only own SoFi Technologies. Right now, SoFi Technologies trades at $5.72, while professionals believe at the low end the company could drop to $5, or on the high end, analysts believe the company could surge up to $10 per share. Now let's talk about Palantir Technologies and where this company is headed in the future. If you don't know, Palantir Technologies is a big data and analytics company that serves both commercial clients as well as government agencies. They currently trade for $8.15, while professionals think the company could fall as low as $5, while more bullish professionals believe this company could surge up to $15 per share. Most analysts right now, out of the 14 professionals which are currently surveying this stock and company, they have a hold rating. 2/3 of these experts actually have a hold rating. But despite that, this author believes Palantir Technologies is very well positioned, mainly due to the AI and artificial intelligence fad, which is another reason why people are so drawn to this company. As the artificial intelligence race starts to heat up across the globe, it's going to show that more and more companies need to become reliant on artificial intelligence. And to continue to scale their businesses are going to have to enact more artificial intelligence platforms. Palantir could be a key beneficiary from this new overall market trend, which is going to go way into the future. Palantir essentially is able to gather large amounts of data and then present this to management to where their management can make data-driven decisions. And I also want to point out, on their Q4 earnings call, Palantir's management mentioned that they were witnessing a positive momentum from their smaller clients signing up for longer-term contracts and enterprise deals with Palantir Technologies, and that is phenomenal news, especially considering the macroeconomic volatility that we've experienced as of late. It's great to see their smaller clients double down and really start to invest into Palantir's technology. The company has signed a total of over 133 deals with small businesses that give them revenue of less than $1 million, meaning that as these smaller companies start to scale upwards and they utilize more of Palantir Technologies' platforms, this is going to be phenomenal news. But where is the risk in this company? Now, here's where I get skeptical about this author. He says that the risk to reward is still attractive, and I would agree with him. Yes, there is more upside in the stock than there is downside, technically, as long as you hold this company over the next 5 to 10 years. He says that the PLTR stock price, and according to the chart, this supports a buy rating for the company. The chart below, according to him, gives a sense of how oversold Palantir stock looks compared to their other North American tech peers. So essentially, he's just giving the overall average, which he has here on screen, and he says that Palantir is substantially below this line and they should be trading above this line, meaning that the share price is extremely undervalued. And he also points out that their RS ratio is almost 2.5 times lower than the midpoint of their overall lifelong range. However, this is where I would actually push back on him. Clearly, During this time, this was overhyped and the company was over enthusiastic about future projections, and investors went a little crazy. I think it's much more palatable and attractive now than it was back then, because at that time it was completely overbought in my opinion. So I would love to hear your thoughts down below. Overall, Palantir is set for long-term growth. However, in the short term, be wary of articles like this saying that the company should be trading over $20, when honestly right now is probably a more realistic price point going forward. And until they can start to scale their overall platforms in the future, going back to at least above a 20% revenue growth rate, then you should definitely just keep an eye on the stock, or at minimum add it to a watch list. Lastly, let's talk about Tesla's TSLA shares, which is an electric vehicle company that also specializes in energy generation. Investors in Tesla know that it has been a wild ride, and their upcoming first quarter delivery numbers have all investors looking into this company even more. There are only a couple of trading days left in the quarter, and investors are very tightly pressed to determine where this company is headed in the future. So far, Tesla is up around 54% in 2023, so they have started off the year with an absolute boom. And right now they're trading between $190 to $197. Once Tesla releases their overall delivery numbers, I think they're going to beat on their delivery numbers, which is going to cause the overall TSLA stock price to pop a little bit. The January 3rd disappointment was the main reason why the TSLA shares dropped in the first place by around 65%. Ever since then, the company has been on a massive bull run, and I think it will continue as they release their deliveries over the next few weeks. I also want to point out that Dan Ives recently reported on Wednesday, and I quote, "all street eyes on how demand is holding up for Musk and company in the shaky macro." Essentially, he's alluding to, if Elon can pull a win here and deliver impressive delivery numbers despite bad macroeconomic conditions, this is going to translate into a very high TSLA share price. If Tesla can deliver roughly 430,000 units or more, this is going to lead to the stock price absolutely surging. Right now, Tesla bulls have around a $220 price target. I personally have a $250 price target, while bear and naysayers have a $24 price target, which is absolutely ridiculous. Like, oh my gosh, just look at the company. There's essentially no ratios that say this company should only be worth $24, so I have no idea where they are getting that price target. So how high could the stock price go if they bring in a deliveries beat? Well, if they bring in a deliveries beat, the TSLA stock price could surge up to $215 in the short run. However, if they miss, it could fall down to or below $185. Many analysts and bearish naysayers believe the company could be as low as $160 if they miss this overall opportunity, but I don't think they're going to miss, and I think those are way too low. I am still really rooting for Tesla to reach $250 by the end of the year, but I would love to hear your thoughts down below. So don't forget to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and I'll see you in the next YT video.